Hey everybody, how you doing? It's Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 20th, 2024. How you doing? Hey, I really appreciate you being here. I hope this podcast is going to be helpful for you. Have a lot of great things to cover and some good teaching moments and some good trades, actually. In the last month, I've had one of my best trading stretches in a long time, and it just goes to show you that you're not going to have huge weeks, huge months all the time. A lot of times you're going to have losing ones, but if you have a good process that you follow with good risk, identifying good levels, having good risk to reward ratios, and really more importantly, having a process that keeps you in a winning trade. Most people, everything revolves around stop losses on trading, and it's true for sure. But I don't think there's enough attention given to the process of staying in a winner, because it's hard to stay in winners for a lot of people. It feels good to hit that sell button, lock in that profits, but really, you have to risk open profits to make more profits, but you can't just base it on how you're feeling at that moment. You really need a process. So, in today's podcast, I'm going to really try to explain the process of staying in a trade. All right. So, like I said, I hope you're doing well. The market has changed quite a bit. I'm going to go over that as well. We're going to take a look at the indexes and I hate to say it right now, but like the Nasdaq has broken structure to the downside. So I'm not saying that you can't get long, but right now with the current sentiment, I am looking to short rallies, not buy dips, unless it gets low enough that it starts getting into deep dip buy territory or fair value gaps or order blocks or major moving averages as low RSI. So in the podcast today, here's the format. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the daily time frame and the weekly time frame. We're going to talk about why I entered, or when I entered, why I entered, what the setups were, what the confluences, what the combinations of indicators or levels of support were, what the risk to reward ratio was, where I'm going to place my emergency stop, where I'm going to have my end of bar stop, how I'm going to take partial profits if the trade goes my way. I'm going to look at significant overhead resistance levels, certain RSI levels, and how I'm going to get out of those trades. All right. Um, and then most importantly, just going forward, the process, what I'm going to do with that trade. All right. After that, we're going to talk a little bit about trader psychology. Really, the most important skill in trading, everyone, is the ability to create a plan and follow it. That's it. Position size correctly. Be patient. Wait for the price of the market that you're trading to get to an important level where you have confluences, combinations of indicators, having a good risk to reward ratio, position sizing correctly based upon the volatility and the amount of money that you have in your account, um, and then taking on that trade and knowing what to do with it regardless of what the market does. You have no control over the market. You have to know exactly what you're going to do, whether it goes your way or goes against you. You have to know, regardless of what happens, you have to know what to do. If then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. All right. It's a plan, it's a process. But from a trader psychology standpoint, you have to be able to follow that process. We all know how to lose weight, eat less food, eat better food, work out more. We know how to do it, but do we do it? You know, it's the same with trading. The trading strategy and its trading process is not difficult. The difficult part is following it. And so, that's why I like to talk about trader psychology. I hope it's going to be helpful. After that, I have gone down through my watch list of the markets, both on the daily time frame and the weekly time frame, and I have identified Some good potential entries for next week. Um, on Friday nights, I go through my charts, daily and weekly time frames, and I say, if this particular stock gets to here, then that might be a good place to enter. It's not there yet. I'm not going to mess with it yet, but if it gets there and has this confluence or that confluence or this setup or whatever, then that would make sense. And it doesn't mean that it's going to be a profitable trade if it gets there, obviously, but it gives me a good risk to reward ratio. It gives me a good structure. You need to have a good structure for your trade so that if you're wrong, you can be wrong small. And if you're right, you have the potential for some big outsized gains. Like I've had this week, and I'll show you where the risk to reward was very good. The risk was very small, but the gains were very big, and that's what you need. Sometimes you need those big outsized gains to pay for all of the guaranteed losses that you're going to have in trading going forward, for sure, right? You're going to have them. They're just the cost of doing business, but you have to be able to occasionally have some big gains to pay for all those, so you have something left over. All right, so we'll go through. There are some interesting setups potentially for next week. Especially if you're looking for something in tech, which over the last week or a little bit longer has really been hit pretty hard. And if you've been listening to this podcast over last month or so, I haven't been touching any of that stuff up there. None. That was just in nosebleed levels. And sometimes it stays in nosebleed levels for a while. You feel like it's never going to come down. But let me tell you a little secret. They always come down. They always come down. So now some of this stuff is starting to get interesting again. So we'll go through that. I hope that's going to be helpful. If that is helpful, or any part of this podcast is helpful to you and you find it of value, I really would appreciate it if you could hit the thumbs up button. It really helps out the channel a lot. It lets YouTube know that there's some valuable content. All right, so let's get started by running the U.S. legal disclaimer. We'll get that out of the way, and then we'll come back and we'll get started. All right.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started on the open positions that I have. So this is UNG. This is a short position. One of the biggest trades percentage-wise I've had in a couple years. Ironically, one of the biggest trades I had a couple years ago was UNG to the upside. They were both about 50% moves. Last time it was to the upside. This is to the downside. But let's take a look at why I got short this and why. Okay, I did get short back here on June 12th, right here when we rejected the 200-day moving average. This is the black line here. And, why did I get short? Well, let me show you something here with this trend line here. We had this huge parabolic up move, drew a nice trend line of support. Then we broke the trend line. When you break structure from a pivot point standpoint, or you break structure from a trend line, then any subsequent rallies that happen, I'm looking to short, because when you break structure to the downside, I look at it as, okay, you're in a downward move. If you're in a downward move, I want to short rallies. Okay, so you see this this blue box here. What is this? This is an order block. This was the highest up bar close before the market structure break to the downside. So when you get back into that order block area, that's where I'm looking to short. In addition to that, we have the 200-day moving average, the downward sloping 200-day moving average, the black line. This gives me a very good line in the sand to base my entry or exits off. So again, we have a break of a trend line. We took out this pivot point, which puts us into a downward market structure, in my opinion. We have a rally. When we break structure to the downside, I want to look to short the rally. Well, I shorted the rally here when during the day, we went above the 200 and closed below the 200-day moving average. Now, so I entered here at $20.82. When I enter a trade, the first thing I do is I place my emergency stop 2 ATRs above my entry. This is this red line up here. If it gets there at any time during the day or whenever, I'm immediately out. If I get there, I know I've lost 1% total of my capital. It doesn't happen very often. It only happens about 5% of the time. The other 95% of the time is my end of bar stop triggers. And in this particular trade, the 200 was my end of bar stop. So this is what I'm talking about when I talk about having a line in the sand and a good risk to reward ratio. The black line is the 200. If the next day we simply would have closed over the 200, I simply would have been out of the trade for a small loss. That's it, right? Emergency stop 2 ATRs above. That only happens about 5% of the time in my experience. 95% of the time, it's going to be the end of bar stop, which, like again, I entered at 2082. If it had just closed above 200, the black line, I simply would have been out of the trade. All right. Now, I have an orange line down here. This is my trailing stop level. This is 1.5 ATRs beneath my entry. Remember, this is a short. If it gets to this level, then I go into what is called trailing stop mode, which all that means is if I then get a close above a previous bar's high, again, because I'm short, then I'm going to exit half my position. Why do I do this? When I move, whether I'm long or short, if I get to where I want to, if it's moving my way, 1.5 ATRs, then it tightens all the stops up, because then if I have a close above a previous bar's high, I get out of half, which by default readjusts and realigns and recalibrates and tightens up all of my stops. All right. Now, all of these things, the emergency stop, the end of bar stop, the trailing stop level going into trailing stop mode, these are all defensive moves. That's if something's going against you, right? But I also like to play offense. You need to play offense and defense. It's important. Any sports team, you need to have good offense, good defense. So what is the offensive part? The offensive part is if the price moves the value of 0.45 from the previous bar's close. If that happens the next day, if it moves the value of 0.45, I will take off 10% of the remaining shares that I have. Okay, and I do this 3 times. So let me explain here. So right now, the price is, I'm still short. The price is $14.30. So I take $14.30 because I'm short. I'm going to minus 28 cents. This is for Monday. Whatever that comes out to be, I guess that's 1402. If I get to 1402 on Monday, then I'm going to take off another 10% of the remaining shares that I have. I'm going to do that 3 times. 1430 minus 28, that's my first profit target for the day. Take the first profit target minus 28 cents, that's the second profit target. Take the second profit target minus 28 cents, that's the third profit target. I always have 3 of them in the system, okay? And so all the way down here, I've been taking profits, been taking profits, and it's good. I really think taking partial profits is great, especially psychologically. because it keeps reducing your position size. And what's the benefit of that? The real benefit of that is that it takes heat off and it helps you follow your plan. If you have a full position here, you're like, man, this is moving pretty well my way. You're more likely to get out of the trade and not follow your process. So for me, at least, taking those partial profits really, really helps. Okay, so let's go back to the trade. We broke the trend line, put us into a downward market structure. We broke the pivot point, reaffirms that. Now I want to short rallies. The 200 made a lot of sense because it's such a good risk to reward ratio. Next day moves down. I took a little profit. Next day, not much. Next day moves down. I took a little more profit. I got to trailing stop level. Now I'm in trailing stop mode. The next day, we have a close above a previous bar's close after reaching trailing stop level. I took off half of the remaining position for a gain of, what is that? 4.82%. 4.82%. Pretty good, right? But I only took off half, thankfully. Next day we move down. I take a little more profits. Here in this, I think I hit a profit target every day. Now, when I got down into this level, when I got down into the 35 RSI level, now if I have a close above the 5 EMA, I'm simply going to get out completely out of the trade. You can see here on this day, on the 12th, we almost closed above it, but we didn't. This is a nice, good, tight trailing stop level now. Didn't close above, so I stayed in, down, took some more profits. Sideways or inside bar, didn't do anything. A few days ago, down, took some more profits. Now, on this day, we closed below 30 RSI. So now it becomes easy. If I have an under 30, over 30, I'm going to take off another half of the position. This happened here. I took off half of the remaining shares that I have, and going forward now, if I get a close above a previous bar's close, I'll be completely out of the trade. This particular trade right now, well, that right there was 47.41%. And the remaining shares that I have right now up 45.59%. So huge trade. These don't happen very often, okay? I wish they did, but they don't. But again, it was important that I had a process that kept me in the trade. So I have the remaining shares I have left up 45.59%. Thursday, I covered another half of the remaining shares position for a gain of 41.11%. So really great trade. And ironically, natural gas is a mover. A couple of years ago, I had over a 50% gain on natural gas, just using the same kind of signals, but they were long signals, obviously. So really amazing, great trade. All right, SLV. Excuse me. Excuse me. All right, I did get short SLV here on the 16th of July. Why? Well, if you've been watching the channel, you've heard me talk about abandoned babies and island reversals and how they're some of my new favorite approaches. So you can see this bar here in the red. What we did the day before that bar, we gapped up. So there was a lot of positive sentiment in the trade in this particular market in silver. The next day, however, we gapped down. So we went from very bullish to very bearish very quickly. When sentiment changes, when it does a 180 from very bullish to very bearish, usually looking into the future, you're going to see that market lower. Conversely, look here, here's the opposite. We gap down, very bearish. Next day, boom, we gap up, very bullish. Looking in the future, you're probably going to see higher prices, which obviously we did. And by the way, if you really want to learn more about the abandoned babies and the island reversals, I have a video on YouTube in the lessons playlist of why they're some of my new favorite approaches. Go and check it out. I think it'll be helpful for you. So I could have entered on the day that the abandoned baby formed. You can see it hanging out here by a little bit by itself. That's why it's called abandoned baby. But I prefer to let the gap to be filled unless it's really tiny and I have a good risk to reward ratio. So gap up, gap down. Here on the 16th, I got short when it came back and filled the bottom of that gap. A lot of time when you change structure to the downside, you will have an attempted rally up first. Now, with these particular trades, I have chosen to make a pretty simple profit and loss proposition. I entered here 28.48. I put a 2 ATR profit or stop loss above me. Just simple. One of two things is going to happen. I'm going to hit my 2 ATR profit or my 2 ATR stop loss, or I'm going to hit a 4 ATR profit target. So my gain is 2 times what my loss is. All right. In my experience, a good abandoned baby or island reversal tends to be positive about a little over 70% of the time. So if you think about it in those numbers, if that holds true, if those numbers hold true, 30% of the time, I'm going to lose 2 ATRs. 70% of the time, I'm going to make 4 ATRs. And that's proper risk to reward, making twice as much as when you lose. I mean, even if it was 50%, are you okay with 50% you lose 2 ATRs, 50% you make 4 ATRs? Sure, absolutely. You'd make money all day long with that. But in my experience, these abandoned babies and the island reversals have an even higher percentage than 50-50, at least in my experience since I've been using them. So I place my 2 ATR profit target up here, place my 4 ATR or 2 ATR stop loss up here, place my 4 ATR profit target here. One of two things is going to happen. I'm going to lose 2 ATRs or I'm going to make 4 ATRs. Friday, it was down so much I thought, man, I may hit my 4 ATR profit target right away. So anyway, it worked out really well. And currently, this particular trade is up 6.25% in 3 days. So that abandoned baby really did make the call there. So great trade there. USO. Okay, this is similar to natural gas because we had a market structure change. Look at this trend line here. This is USO, this is oil. Look at this trend line. Here on the 8th, we broke below the trend line. Okay, to me, that makes it into a bearish market structure. I want to short rallies. Here is your order block. Here is the highest up bar close before market structure change. And so anywhere now from the top or the bottom, this is the red area here, this is what I'm looking for as far as a place to short. In addition to that, what is this? Friday, Thursday, Wednesday, Tuesday. On Tuesday, we broke below the swing low, adding to the case that we had broken market structure to the downside. So technically anywhere in this red box after this market structure change, I could have shorted, really. And that's the thing about fair value gaps. That's the thing about order blocks. As soon as it came back up to this bottom of this red bar, I could have shorted, but I like to be a little bit more technical with it. But it's not just black or white. It's kind of up to the trader where and how and why they want to enter the short. To make it simple, yes, just as soon as it got back in here, you could have got out. This would have been your stop up here. But I really didn't see it until Thursday. And on Thursday, again, we're in the red box. We're in the shortable box. But in Thursday, in addition to being in the short red box, I also had a V1 to the downside. A V1 to the downside consists of 2 bars, bar 1, bar 2. Bar 2 goes above bar 1's high, closes below bar one's close. And if you want to learn more about V1s and V2s, again, go to my YouTube channel. I have videos on V1s, V2s. I use V1s, V2s all the time. They're a big part of my trading. So this by itself is bearish because we went above the high, closed below. So I did get short here at 79.89 in the shortable area. Again, the shortable area is because we broke market structure to the downside, both from a trend line perspective, also from a swing low perspective. So as soon as I get short, what do? Well, immediately, okay, so I got short 79.89. I placed my emergency stop 2 ATRs above. Now, with a V1 or a V2, the thing I like about V1s, V2s is the stop loss is very close. This is the washout bar on the V1. All that means is we went above bar 1 and closed below. So we washed out bar 1's high. That's why I call it the washout bar. My end of bar stop is simply right here, halfway below or halfway of the V1 bar. So see how close it is? If it closes above 80.33, I'm simply out of the trade. And by the way, everyone, and I'll talk about this later in the podcast, but looking at this, you might say, oh, those rules look really hard, and I don't think I'd ever get that. Really, it's not that hard. It's really not that hard. It's just that in an hour in a podcast, I can't go through all the nuances. So, if this kind of stuff interests you, I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course where I teach you step by step all the different trading approaches that I use, all the ones you see here. I teach you that step by step. We do lots of simulations. I make you drive. We go through random charts, random time frames, and I say, okay, what do we do here? Do we make anything? Do we get in? Do we take profits? It's a really good way to learn. And I've been trading for almost 29 years now, so you get a lot of experience. I've been through many, many markets, but I love to teach. I taught people from all over the world. So if you're interested in taking this one-on-one course with me, I promise you're going to learn a lot. You're going to be a much better trader when you're done. And my email is in the link in the description. So just reach out to me. All right. And I'll talk a little bit more about it at the end. So again, we're in the shortable red box because market structures changed to the downside. I waited for a little tactical entry, V1 to the downside, got short here, 79.89, 2 ATR emergency stop above. Usually only 5% of the time I'm going to hit that. End of bar stop, simply a close now above 80.33 because it's halfway of the washout bar. Plays my 1.5 ATR trailing stop level to the downside. Boom. One day, we got it. We are there. I'm in trailing stop mode. What does that mean again? That means that if I have a close above a previous bar's high, I'm going to get out of half the position. Now, again, did getting short here, 79.89, did I get some profits on Friday? Absolutely. I hit 3 profit targets because look, the 0.45 ATR is 60 cents. So on Thursday, I placed my 3 profit targets below. I hit 3 of them. And how much did I get out of each one? 10% of however many shares I had to start the day. So this particular trade really started off well, already up 2.54%. All right. So those are the daily, the current open trades. I have a quarter position left on UNG, up 45.59%. Silver up 6.25%. USO up 6.25% on silver, and USO up 2.45%. Now, these are the current open trades. Let's get to the closed trades. I closed out a lot of trades last week, yesterday and Thursday and yesterday, but they're really good trades. Let's take a look. Home Depot. All right, we'll try to go through these a little bit faster. Home Depot. I got long here on the 5th of May. Why? Intraday rejection of the 200-day moving average. Higher low, intraday rejection of the 200-day moving average, and a V1, bar 1, bar 2. Bar 2 goes below, bar 1's low, closes above. Got long 334.58, Place my emergency stop 2 ATRs below. My end of bar stops close below the 200-day moving average. Place my 1.5 ATR trailing stop level here. And again, if we move up more than at least the value of 0.45, I take some profits. Next day, moved up. I took some profits. Here, I took some profits. Here, I took a couple profits. Here, again, up, sideways. 2 profit targets here, another profit target here. Now, at this point, when we get this far extended, now I have to look for, hey, when am I going to get out of this thing? I got out of half of the position on the 18th of July. Why? Because it went over the 70 RSI and under the 70 RSI. I got out of half of the remaining shares for a gain of 8.53%. I exited the rest of the trade on Friday. Why? Because after rejecting the 70 RSI, I had a close below the previous bar's low. Totally out of this trade now. And that second I'm sorry, yes, 7.84%. So Thursday I got out of half the position for 8.53. Friday got out of the rest of the position for 7.84. But look at the risk to reward ratio. This is what I'm talking about. I'm talking about waiting for it to get to a major support level like the 200, taking the trade. If it closed below the 200, I'm simply out. If I'm right, I have the potential to be right big. So I was risking very little in this particular trade. Worked out well, made a lot. That's what trading is about. So Home Depot out of that position. XLE, okay, entered this back here on the 18th of June. Why? Notice the 200-day moving average. Close under, close over, got long 88.58. Placed my emergency stop 2 ATRs below. Moved up, took some profits, moved down, did nothing, moved up, took some more profits, got to trailing stop level, first close below previous bar's low after reaching trailing stop level, got out for a gain of 2.74%, moved up, took a little profit target here, ooh, came all the way back down. If it had closed below the 200-day moving average, it would have gotten out, never closed. Moved up, more profit targets. Here, more profit targets. Here, more profit targets. Here, more profit targets. And at this point, we were above the 65 RSI level. If I'm above the 65 RSI level and close below the 5 EMA, I'm out of the trade. I exited the trade on Friday. Closed barely below it for a gain of 4.14%. So really good trade. IWM. Okay, this is another approach that I use, and obviously that I trade with and teach. This is called a higher low V2. Please look at the green line here, the green line here. This is called the value zone. This is called a higher low V2. We closed below the value zone. We came into the value zone. We had a pullback, and then we had a V2. Here's bar 1. Here's bar 2. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. Got in at 202.30. Placed my emergency stop 2 ATRs below. My end of bar stop on a V1 or V2 is a close below halfway of the washout bar. Here is this bar here. You can see this line at 250. If I'd closed below here, I simply would have been out of the trade. Placed my 1.5 ATR trailing stop level here. Here we came down, look, to the penny, halfway, but it closed above, kept me in, moved up, took profits, moved up, took profits, moved up, took profits, moved up, took profits, moved up, took profits. Okay. So then I'm in trailing stop mode. On Thursday, I had a close below a previous bar's low after reaching trailing stop mode, and we also closed below the 70 RSI. That got me completely out of the trade. This was a very, very good trade. Gain of 7.18%. And then last but not least, on the dailies, Caterpillar. Very simple, higher low V1. Again, green bars are the value zone. Anywhere in here is the value zone. We close below the value zone. We rally into the value zone. We pull back. We have a very nice higher low V1. Bar 1, bar 2. Bar 2 goes below bar 1's low. Bar 2 closes above bar 1's close. I got long 328.20. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below halfway of this washout bar, 324.90. Trailing stop level here, 1.5 ATRs above. Moved up, took profits. Moved up, took profits. Got into trailing stop mode. Moved up, took more profits. Couple profits. This bar here, I believe I hit 3 profit targets, if you can imagine. Then we had a move back down here. Here, we gapped way up high. Took a couple profit targets there. Then we closed below the 70 RSI. I took another half off at a gain of 7.74%. And then on Friday, we have a close below previous bar's low after rejecting the 70 and closing below the 5 EMA. I know a lot of stuff going on here, huh? For a gain of 5.59%. So those, unbelievable. Unbelievable. They were all these trades, all profitable this week, long, short, all sorts of different trades. So it was wonderful. So on the closed trades, out for a gain of 8.53%, 7.84%. XLE exited the position positive 4.14%. IWM up 7.18%, and Caterpillar up 7.74% and 6.59%. So, McDonald's on the weekly. I do have one weekly trade here as well. So I got into McDonald's on the weekly here at 245.90. Now this was a little bit of a different trade. I knew this 200 week moving average would probably be a significant level on the weekly. Now, if I did this the normal way, I just would have got in at the end of this week because of the intra-week rejection of the 200. But what I did was when we were down near the 200-day moving average, or the 200-week moving average, I drew the line at the 200. And then on the daily, I saw that on the daily, see, this black line is the 200-week moving average. On the daily, it went below the 200-week moving average and closed right above. So I thought I'd get in a little bit earlier. I'm glad I did. So I got in at 245.90. But then I'm managing the trade on the weekly. So then it moved up strongly. I definitely hit profit targets along the way. I just got in a little earlier based upon the daily. And then this week we were up again. So the significance of this week is that this current week is that I did hit a profit target from last week's close and also got to trailing stop level. So this particular trade now is in trailing stop mode. It is up 4.49%. We do have earnings coming out though. It looks like here the chart says July 29th. Have to it's always good to double check that, by the way. But I don't hold through earnings. So when the time comes, the day before earnings come out, I will exit the trade. So up 4.49% on the weekly. So unbelievable. One of the best trading weeks I've ever had. Everything was positive and very grateful for that. And be grateful when you have a really good week. Really be grateful because they don't come around all that time, all that often. And if you do have a week like that, really check yourself because you didn't really do anything. Yeah, you got into the trade and you have a process, but the market didn't. Don't start, feeling like you're bulletproof and hey, everything I do is perfect because the market has a really good way of teaching you that that's not the case. But enjoy great weeks when you have them. Most important thing though is that you were patient, you waited for the trade, you position size correctly, you got in and you let the trade play out based upon your plan. You didn't get in and mess around with it. All right. But I am grateful for that really, really, really great week. All right, let's talk a little bit about trading psychology before we go ahead and look at the potential trades for next week. All right, before we look at next week's potential trades, let's talk about trader psychology. Again, most important skill. This is from Victor Sperandio. Hope I said that right, but this is a really good post, everyone. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. You know, I often have people say, like, what's the best trader? Like, who do you think would be the best trader? And I said, I can guarantee you it wouldn't be a graduate of Harvard or Yale or MIT. I said, I'd probably take a 19, 20, 21-year-old kid straight out of boot camp. And they're like, really? Why? And I said, because they know how to follow orders. They don't think that they're so smart that they can outsmart the market. That's the problem with smart people. It's the problem. People will have very educated people, have very high IQs. The market does things that it shouldn't do. And intellectually, they can make a really good case against the market going up, but it still goes up. You take that kid, man or woman, kid, girl, boy, kid, young, out of boot camp, they're not going to try to outsmart the market. If I teach them how to trade, they're probably just going to follow what I said and not trying to overthink it. I have a friend, very, very high IQ, super high IQ, genius level IQ, really has had a difficult time trading because they use their intellect to go, the market should do this, it should do this, and it completely did the opposite thing. That's why it's so important really to follow the technicals. That's why I'm such a big fan of technical analysis. Let's read it again. The key to trading success is emotional discipline. If intelligence were the key, there'd be a lot more people making money trading. A lot of smart people out there, a lot of people losing money trading. Why? Because they're not following the rules. They're trying to outsmart the market. So check your ego, check your IQ, just get yourself a process to follow and follow it. I talked to a good friend of mine, former student of mine, exceptionally smart, intelligent person. He never, and a great trader, he never listens to the news. He never reads about the market on purpose. He doesn't want to be infected by the narrative of the market. He just wants to follow what the technicals are trading. He's that smart. He's so smart that he knows that he's smart, that could be an issue for him, and so he just blocks it out. And he's a great trader, and he's doing very well. So the key to trading success is emotional discipline. You have to have discipline. You have to have a process, and you have to have the discipline to follow the process. If intelligence were the key, there would be a lot more people making money. Just get yourself that process and follow it. Okay, before we get on to next week's trades, look what happened yesterday. I took this video. I was kind of in shock. Let's take a look. I was sitting there trading, and here comes a little family of quail. And I saw these little quails when they were just born. They were so tiny. And here's the mom and the dad with the group, and they've never gotten this close to my house before. And I was amazed at how big they were and how comfortable they were to come to my house. So I was glad I had my phone handy, and I just recorded this. But now watch what happens. This guy
Hello. Hey, what are you doing? No, you gotta go outside. Oh my gosh. Oh my gosh. You guys are growing so big. Hello.
Okay. Anyway, that was really kind of a special moment for me, and I just wanted to share that with you. So anyway, I hope you liked that. And yeah, for me, it was great. because I had seen these quails before they had their babies. They were walking around the yard. They were checking out where they were going to lay their eggs. And I was like, oh, pretty soon I'm going to see this little family of quail. And there they were. And then here yesterday, they just show up while I'm trading. And I was like, oh my gosh. And then the little, I think it was the dad, came in. I'd been fine with him to stay, but I just didn't want him to get nervous in the house and get away from his family. So anyway, just want to share that with you. Okay, let's get to what I'm looking for next week. Again, these are not where they need to be yet. If they get there, then I'll consider taking the trade if it's a good risk to reward ratio. If they're not there, then fine. I just move on to another market. This is Adobe, ADBE. This one's pretty simple. This is a deep dip buy potential. Here's the black line. Here's the 200-day moving average. Next week, and it's in the value zone. See the top green line, the bottom green line? Anywhere here is in the value zone. Things always come back to the value zone. I don't want to buy up here. I want to buy in the value zone and sell up there. Or I want to buy below the value zone and usually sell in the value zone. So we are coming to an interesting spot here. The black line. Next week, if we have an intraday rejection of the 200-day moving average, giving me a good risk to reward ratio, I'll consider it. If we have a bounce at the 200-day moving average, I'll consider it. If we have a close over the 200-day moving average, I'll consider it. These are deep dip buys. So I don't know. Maybe it will just keep on going down and I won't get into it, but I'm looking for a rejection. I'm looking for a rejection of price under this 200-day moving average. So maybe Monday it goes down, then it closes a little bit above. Yeah, I may decide to take that trade. I don't know. And then if it closed just below the 200-day moving average, I'd simply get out. So I don't know. It's important to wait for confluences and combinations of indicators. I mean, look, here I have 12 potentials for next week. Theoretically, all of these could trigger on the same day, right? Theoretically, they could. Does that mean I would take all 12? No. I'm going to take the trade that has the highest quality score, or in other words, that has the most confluence or combinations or triggers at the same time. Look, Adobe may just go under the 200 and over the 200 and that's it. But maybe NVIDIA goes under something, over something, has a V1. Maybe the weekly looks good. Maybe the relative strength was good. And, again, this is what I teach in my private one-on-one course. I teach you how to differentiate between multiple entry triggers. I mean, here, again, we have 12. These could all trigger, but I narrow it down to the best one of the day. And that has to do with which one has the best risk to reward ratio, which one has the best confluence of signals, which one looks better on the higher time frames, which one has better market relative strength than the rest of the market, or if I'm short, which one's weaker rest of the market. But this is the devil's in the details of how to narrow down to the best one. So just a rejection of the 200-day moving average, maybe, but maybe something over here in these other 12 signals has that plus more, right? I always want to put the odds in my favor with the one that has the highest score, the one that has a V1, a rejection of the 200-day on one stock compared to on another stock, a rejection of the 200-day and a V1. I'd go with that one. That one has a higher score, right? So anyway, it's potential. We'll see on Adobe. Who knows how this is going to play out? But I am going to be watching Adobe for a rejection of the 200-day moving average next week. So there's Adobe. AMD. Oof. Look at that, everybody. Straight up, straight down. Wow. Well, we are into some interesting levels. Look, came down to the 200-day moving average, but was not strong enough to hold it. Now, next week, Monday, if it closes back above, then we'll have a deep dip buy. We'll have a close under, close over the 200-day. Possibility. If it closes above the 200-day moving average, it gives me a good risk to reward. It's possible that I entertain getting into AMD because now I have the 200-day moving average below me as support. Right now, it's resistance. Although, from experience, looking at AMD, really this 250-day moving average makes more sense to me. Not that I won't take it if it closes above the 200, but the 250-day moving average, this purple line, makes sense to me because if we get there, then most likely we'll be at a 30 RSI. Then we'll have the confluence of a major moving average like the 250, and look, here we're 35.96. If you can get a major moving average and a 30 RSI, it's a pretty good spot. Doesn't mean it's going to have to be a positive trade, but it's definitely a good structured trade with multiple confluences. So, I mean, who knows? I don't know. Maybe AMD just goes above the 200 and rockets back up. I don't know. But ideally, just from experience, this level here, about 143, would make a lot of sense. 250-day moving average, 30 RSI combination. So I'm going to be watching that level, the 250, and then also potentially if we just close back above the 200-day moving average, I'll have to see what that looks like as well. So that's what I'm looking for, either a close above the 200-day moving average or a rejection of the 30 RSI, a rejection of the 250-day moving average, or both, or both. ARC Innovations, ARKK. All right, so ARC's been fairly strong, mainly because it has such a large position in Tesla, which has been very strong. But look, here's the black line. Here's the 200-day moving average. Last time we had a close under, close over the 200-day moving average. That trade worked out great, right? It respected the 200-day moving average. Now we've come straight back down, but ARC, the relative strength of ARC is stronger than the rest of the NASDAQ, clearly. I mean, it's clearly stronger. So again, that factors into things. So ARC is fairly strong. If next week we continue down and get a rejection of the 200-day moving average, I would consider that because one, it's the 200-day moving average. Two, that 200-day moving average coincides with this range-bound area of here of support before we moved up. So this area right here looks like there's some support. Of course, it could just go crashing on down, right? We know that. It could. But the 200-day moving average here is interesting to me. Probably more interesting than AMD, actually, because we have the support of this previous range here, and the relative strength of ARC is much stronger. I mean, look, it was up on Friday where the rest of the market was down. So a nice bounce or intraday rejection or close under, close over the 200 would be interesting. Alibaba. Okay, 200-day moving average again comes into play here. We're getting pretty close to it. What I like about the 200 here is, let me bring your attention to this gray line. This gray line is the 50-day moving average. Black line is the 200-day moving average. When you get a 50 closing over the 200-day moving average, you have what's called the golden cross. And everyone gets excited about golden crosses. And long term, yes. But what I have noticed is when you have a 50-day moving average crossing over the 200-day moving average, the first move back down to the 200-day moving average provides an edge. Again, the 50 crossed over the 200-day moving average. When that happens, the first move down to the 200, in my experience, tends to bounce. So I'll be watching the 200-day moving average mainly because we had the golden cross here. Okay, so I'll be watching the 200-day moving average, which is about 74.80. For a bounce, intraday rejection, or close under, close over. Cameco, CCJ. Okay, well, it came right to the 200 and bounced. Did I buy it? I didn't buy it. Why? Because of these big waterfall bars down. When you have big waterfall bars down, you can bounce, but it's kind of hard to get through them. So similar to AMD, I mean, I could next week potentially if maybe we go back under the 200 and then back over or in a V1 or something. Potentially. I can't rule it out, but I decided that's legitimate entry on Friday, but I didn't take it. Again, I'm looking towards the 250-day moving average. It's a really, really deep dip buy here. And if we did get there, we would also be under the 30 near the 30 RSI. So this would be a deep dip buy, just like on McDonald's, just like on IWM. These levels are important. These deep dip buy levels are important. Oh, and by the way, if you would like to learn the deep dip buy strategy, obviously I teach it in my private one-on-one course, but I have a really nice, good uh, uh, online course available at udemy.com. It's very affordable. It's somewhere between $30 and $50, but you get 9.5 hours of video, and I teach you step by step how to trade the deep dip buy approach. And everything that I'm talking about right now, deep dip buy approaches. And the links in the description, the Udemy links in the description. I've sold so many around the world, and I think there's like a 4.9 out of 5 rating on that course. So if you're interested in that, it's a really great place to start. So anyway, CCJ, yes, it was legitimate on Friday. I didn't take it. But my experience right now is telling me that the 250-day moving average down here at about 43.95 would have a better confluence of signals. 30 RSI, major moving average of the 250. CRM. Okay, I just talked about Alibaba with the golden cross. Here's the opposite. Look, here's the 50-day moving average crossing under the 200-day moving average. This is called the death cross. The opposite of the golden cross is that if we move back up to the 200-day moving average, that would be the shortable area for me. In addition to that, you can see I have this red box here. Why? Well, look, we had a high, we moved down, we made a higher high, we came down hard. It broke the trend line. That puts us into a bearish market structure. In addition to that, we took out this swing low. So that also corroborates the downward move. This looks downward to me. The structures have been broken. If I get a structure break to the downside, I'm looking to short rallies. Okay, that's it. So this 200-day moving average will be a very good line in the sand. This is very similar to the natural gas, the UNG trade that I had. But I'm not going to short here. I have to be patient and wait for it to potentially come up and reject this 200-day moving average. If it does, then it gives me a very good risk to reward ratio, and I'm swimming downstream, not upstream, because market structure broke to the downside. I want to look for short entries on CRM. Disney, okay, getting very close to a really nice potential entry point on Disney. Look, we're at 33.28 RSI. We're near the 300-day moving average. These are all interesting levels. Now, on top of that, we have a double bottom and bullish divergence. Look at the bottoms here. Look at the deep red MACD bars. Then we rally. Now look, here we are lower than here, but there's no red MACD bars. This is called a double bottom bullish divergence with a missing right shoulder. I learned about this strategy studying one-on-one with Dr. Alexander Elder. So this is very interesting to me. Disney is very interesting. Regardless of what you think of Disney, the technicals here are starting to make a lot of sense. Double bottom, bullish divergence, missing right shoulder, near the 30 RSI, near the 300-day moving average. A rejection of that 300-day moving average and a rejection of the 30 RSI would be a very good risk to reward ratio. So there's a lot of things that make sense on Disney. I'm not going to go ahead and just buy it yet until I get a signal. Look, closing back above this 250-day moving average, that could be the signal. That's legitimate. So it either needs to go lower or higher. It either needs to close above the 200-day move or 250-day moving average, as long as it has a good risk to reward ratio. If it's way up here, I'm not going to do it. But if it has a nice gentle close above the 250-day moving average, I would consider getting in there. Alternatively, if it goes lower and rejects the 300-day moving average, I consider getting in there. But I really like the double bottom bullish divergence situation in addition to the low RSIs and the major moving averages. MasterCard, MA. Okay, last time we respected the 200-day moving average. We had a close under, close over, nice move up. The relative strength is higher than the rest of the market. Look, if it comes back down to the 200-day moving average next week, I consider getting in the trade. That's all there is to it. I would consider getting in the trade. But again, there's 12 signals here. Just the rejection of the 200 may not be my pick because I may have other ones over here that have higher scores, right? But I will be watching the 200-day moving average for rejection of the 200-day moving average. NVIDIA. Okay. All right. Let's see. All right, everybody. Let's talk about NVIDIA. This is a very interesting area here, both to the upside and the downside. First of all, I want to talk about the danger signs that I saw on NVIDIA up here in the red area. Here's the trend line. We broke the trend line. Okay, that puts, in my opinion, that puts us into a bearish market structure. Here's the order block, the bearish order block from 133, 136.33 to 130.69. This now becomes the resistance area after we broke the trend line to the downside. That's why I marked it in red. The key point here is the halfway of this big down bar. When you have a big down bar, halfway is going to act as resistance. So the dip buyers came in, we came back up, which is kind of be expected, but look, we got right to the bearish order block area, the red box, and we got right to halfway of this move, big move down. Halfway. Isn't that amazing? And look, we came right back down. Now, again, look at this big down bar. Halfway of that right here. That's right where it got to before it failed again. So always be on the lookout for big down reversal bar. That's probably telling you that the high is in. Doesn't mean it's going to go straight down, but most likely it's going to go down. It's going to come back to the halfway and then fail. And here's another one. Big down bar, halfway, fail. Okay. So we have broken all sorts of trend lines to the downside on NVIDIA, but the interesting part is the green box here. This is a fair value gap, a bullish fair value gap from over here. We're getting very close to the 50-day moving average. I don't usually trade off the 50-day moving average, but it would make sense that next week if we reject the 50-day moving average, the gray line, some kind of bounce, intraday rejection of that would get me interested in getting long. I don't think the rallies are going to be sustainable, but decent enough for a trade. So again, big down bars halfway act as resistance. Got right there, went a little bit above it, down. Big down bar, got to halfway, down. But we are, I think, getting to somewhat of a buyable area. Again, rejection of the 50-day moving average would be my area to look at for a potential entry. Bonds. Okay, let's take a look at bonds long term here. Look at the trend line. This trend line really held up well. Here's a low. Here's a low. Draw that out. Came down. That really was the bottom. And then we moved up. Right now, what I'm looking for to get long TLT is this 200-day moving average, this black line. Some kind, if we move back down, I don't know if we will or not, but if we do, I'll consider getting long TLT here with the rejection of that 200-day. And in addition to that, we have a golden cross prior. Look, gray line goes under, closes above. In my experience, as soon as you have this golden cross, the first move back down to the 200-day moving average tends to be a bounceable area. And by the way, if we do get to this level and bounce at the 200-day moving average and TLT goes back up, what does that mean? That means interest rates are going down. That will be good for the market. If we do reject that 200 and it holds and we go back up, that area will probably be a short-term low for the market. Maybe, I don't know, but just from experience, that's what I would say. So next week, TLT, a rejection of the 200-day moving average would get me long TLT, potentially. U, which is Unity Software, I'm looking to buy somewhere in this green box, somewhere between 1562 and 1517. This would be the buyable area. Why? Well, because we change market structure to the upside, and if you change market structure to the upside, I want to buy the dips. How do we change market structure? Here we have a low, we have a lower low. Here we take out this swing high, which puts us into a bullish market structure. Also, we broke the trend line to the upside. But very often when you change market structure to the upside, you're going to have an initial dip. That's the dip to buy. So I'm looking seriously to buy Unity software here if we get somewhere into this green box. The ideal place would be if we came and back tested this trend line in the lower part of the green area. So I don't know if it's going to get there. It may. It may. With the sentiment of the market, it may. But this is the area that I'm looking for to buy Unity, somewhere between 1562 and 1517. And on top of it, we have double bottom bullish divergences as well. So that's a very interesting trade. WBA, Walgreens. Okay, well, we had this low. We went under 30, over 30. That's great. But now look, we're back under 30. We're at a 28.01. If next week we close back above the 30 RSI, then we'll have a higher low close back above 30. We did it back here coming from a lower low. Here, if Monday, for example, if we close above the 30 RSI, we will have a higher low close under 30, over 30. Those are always better. Everything higher low is better, whether it's a higher low rejection of the 200-day moving average, higher low V1, V2 in the value zone, higher low under 30, over 30. Higher low is always better and has a much better chance to trend. So on WBA, what I'm looking for is a close over the 30 RSI to potentially get into that trade. So those are the dailies. Let's go to the weeklies. Only have a couple here on the weeklies. Intel. Had a great trade on Intel back here in this bullish fair value gap. I bought in this area here, scaled out, got out through here. But on the weekly, same with Walgreens. We went from a bearish market structure to a bullish market structure. How and why? Well, we came down, we based. 2 weeks ago, we took out these swing highs, which put us into a bullish market structure. Therefore, if you go into a bullish market structure, I want to buy dips. The area that I'd be looking for on Intel is somewhere between 31.45 and 29.73, somewhere in this green box here. The only tricky point here is that we have earnings coming out, and I don't like to hold through earnings. So next week, if we come back down, first thing off my mind is if we reject the top of this bullish order block, probably get me long, but I'd only be in the trade for maybe 2 or 3 weeks. So I'll just have to see what it looks like, but I am definitely looking to buy. I mean, look, if you look on the daily, look, we had all of this consolidation, we had all of this accumulation, and then we had a move up, which makes sense, okay? But people are going to, it's a big move up. They're going to take some profits. But if we get back down to this consolidation, very likely it will hold there. Not for sure. It could just go right down. You don't know. But statistically and technically, I would say that buying back in this area again is not a bad idea as long as it's before earnings. So if I'm in the trade and earnings come, I'm going to get out. If I'm not in the trade, earnings come and we come into this area and bounce, then I'll probably buy. So I'm looking to get long Intel somewhere between 31.45 and 29.73. But again, I won't hold through earnings. And last but not least is CarMax KMX. Looking to short CarMax in the red box. Why? Well, this was the highest weekly close before a trend line break and a market structure break. If I break to the downside, what do I want to do with rallies? I want to short them. Where's the area to short? The short area would be here in this bearish order block. I know it doesn't look bearish because it's up, but it's the highest close before market structure change. So I'm looking to potentially short KMX somewhere between 88.22 and 85.23. For example, next week, if we came up, touched the bottom of that order block and rejected, that may get me in there. If it doesn't reject and keeps going higher than a reversal bar, that may be the area. Alternatively, if we come up to the top of that bearish order block and reject, that would be the ideal because then I'd have the best risk to reward ratio. Hey, let's talk about the Qs real quick and take a look at the structure of the Qs. So we've had a lot of damage done to the chart, both from trend line breaks and from pivot point breaks. But here's a long-term trend line broke it and broke it hard. Here's another long-term trend line, broke it on Thursday. So we're in a bearish market structure on the Qs. I don't know what else to tell you, but we are a bit oversold here. And so what I'm looking for on the Qs for potential entry would be the green box here of the 50-day moving average. This is the gray line. Next week, if we come down and bounce at the 50 or intraday reject of the 50 or close under, close over the 50, that would make sense, because when you have a big, huge move up like we've had and then a rollover, coming down to the 50 is very normal. It's a normal move back down to the 50. And in a strong uptrend, that's a pretty decent area to buy. So next week, I'm looking for a bounce at some kind of rejection of the 50-day moving average. But if we do rally, we have a lot of resistance above us. Right now, this trend line here, look, we broke the trend line to the downside. Therefore, if we get back up to the trend line, that's going to act as resistance. So keep that in mind. We have a bearish fair value gap here in the red. We have a bearish order block up here. We have lots of resistance above. And look at the volume, everyone, on the way down. Huge. What was very suspicious about these moves up, look, up, 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 up. Look at the volume. Anemic. The downward bars, huge. Look here, big downward bar. We tried to get to halfway. It failed. So be very careful, everyone. We are in a bearish market structure, more so on the Qs than the SPY. But we are coming into some potential levels. And again, this 50 would be an interesting place. So anyway, I hope that helped. If it did, and you found it valuable, I'd appreciate if you hit the thumbs up button. If you'd like to work with me, again, I teach private one-on-one lessons in the evening time via Skype. I'd love you to be a student of mine. I'll teach you everything I know. I'll teach you all the different trading approaches that I use. And I love to teach. And you're going to come away from this a much better trader with a lot of skills. So if you're interested, my email is in the link in the description. I have the online video course available at udemy.com. That link is also in the description. That's a great course. It's a very affordable way to start learning the deep dip buy approach. I've sold so many of those around the world and had such great feedback on those. So consider that as well. But please try to go out and do something nice for somebody today. Please try to go out and do something nice for an animal as well. It just would make the world a better place. And in this crazy world, I think we could use it. So I hope you have a good rest of your weekend. Again, please be careful. The market is definitely volatile. The sentiment has changed. Pick your levels correctly. If you have any comments or questions about anything I mentioned here today, put them in the chat. I'll do my in the comment section. I'll do my best to get back to them. And God willing, we'll see you next week. But please be careful, everyone. Things are a little bit different in the market. Really, really they are. So keep those, be patient, keep those stops tight, and more importantly than anything, follow the plan that you laid out. All right. Thanks, everyone. Take care, and we'll hopefully see you next week. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.